Silver. 6 months ago, silver did something it had not done in a lifetime or yours. On the 29th of January, it printed at $121 an ounce, an all-time record. Then, inside of a single trading session, gold dropped $380 and silver fell 11% alongside it. By the end of that week, silver was down more than 30% from its peak. Today, silver is trading at $57. That is 51% plus below the January high. That is 51% below the January high. And here's a sentence I want you to sit with, because it is the entire reason we are doing this today. Over the same 6 months, the physical shortage of silver in the world did not shrink. It got wider. The Silver Institute of Metals published the World Silver Survey in April. Their number for this year is a 46.3 million ounce deficit, up from 40.3 million last year. 6 straight years of shortage. And since the world has pulled 1 million ounces out of above ground stockpile just to keep the lights on. This is close to a full year of global mine production gone. So we have a market where the price collapsed and the scarcity deepened. These two facts cannot both stay true forever. One of them has to give. Today we're going to figure out which one, and more importantly, what the chart is telling us when. How to read this chart. Start with the shape, because from October through December, silver sat quietly in the 50s. Then January happened, and you could see almost 70% in a single month. It touched 120, and then the exchange raised margin requirements. Remember that time? I made a video on that. Meaning traders suddenly had to pay, they had to post far more cash to hold their position, and the whole thing unwound at speed. You could see on the chart on the left, we had the top line from October of last year to right now. Up and down is the price of an ounce of silver in US dollars. You could see the gray line across in the middle, roughly around $52 to $56, where buyers kept showing up. The gold line from down from the left is a ceiling, and then when the ceiling meets the floor is where we're standing right now. Right? You could see the top. I'm looking at the top chart right now. Since then, we have had a series of lower highs. 19 March, 19 May, 70 in June, and now 57. Draw a straight line across the top of those rallies, and you get that gold line, a ceiling that is descending towards the price. So this is, I drew that line to the right. Meanwhile, the lows have been holding at the same neighborhood, right? The 17th of July, silver briefly dipped below 55 for the first time since December, and buyers took it right back. That is the floor. When a descending ceiling meets a flat floor, chartists call this a falling wedge, and the plain English version is much better. Picture a wedge of cheese, thick on the left, tapering at the point on the right. Price is being squeezed into that point. It cannot stay in there. In a matter of weeks, it exists, and it usually exists fast. Now, here's the honest part. A falling wedge does not tell you which direction it exists. Anyone who tells you it does is selling you something. What I'm telling you is that the size of the next move is going to be larger than the size of the last few. And that is a tradable piece of information by itself, because it means you can define your risk before the move happens instead of after. Before we go any further, find this useful, hit and return on the bell, right? Because when this wedge breaks, I'm going to cover it the same day, and you will want to see that one live, and therefore become a member. I talk to my member every single day. I offer up to, depending on your level of access, 10 different tools that is fed to you throughout the week. So you have different angles, different understanding of what's going on. And that's important. I have basically 2 separate membership levels, the wealth builder, the tactician. Let's move on. So underneath the more obvious, which is the price of the silver, you have, stay with me on this, the second line, which is called the RSI. That stands for Relative Strength Index. And I promise you, it is simpler than it sounds. Think of RSI as a speedometer for selling pressure. Not where the car is, but how hard the pedal is being pushed. Now look at what happened between May and last week. The price made a lower low. It genuinely went further down, right? You could see the chart, the price went down, right? But this made a higher low. The car kept rolling downhill, but the foot came off the pedal, basically. Traders call this a positive divergence, and it is one of the most reliable early signals in technical analysis. It does not mean buy tomorrow. It means the seller who have been in control for 6 months are running out of ammunition. Each new push lower is taking more effort and producing less result. The reading very recently was 37 points. Not oversold. They never got to 30. And that is actually the encouraging part. It means the last leg was not a panic. It was an orderly selling into a quiet tape, right? Orderly selling ends. Panic selling is what makes lows. Orderly selling is what makes bases. And a base is a much better foundation to build a rally on. So what am I saying here? Well, I'm saying three things. One, the price is lower than it was in January. That's obvious. The second thing, and I'm telling you, is that there is less silver going around for everyone to use. Third, I'm telling you from a technical analysis perspective, we are selling, but we're not selling very fast or very hard. That could be a sign of something. Just put it all together. Again, this is about education, right? I'm not here to predict the silver market. I'm just explaining what's going on, and then you make up your own mind. Now, let's go to the third one. There is a third panel at the bottom of that chart, and it is the one I've been staring at. It is called the Bollinger Bandwidth, and here's what it measures in plain English. How much silver has been moving around lately? High number, wild market. Low number, sleepy market. In January, that reading blew out to 64.58. That was the sound of the entire market changing hands at once. Boom. Today it reads 4.63, 64.14, right? And the 12-month low is 12.23. We're effect at the floor. And here's the thing every experienced trader knows. Volatility is not a direction, it is a cycle. Quiet markets store energy, loud markets spend it. And the transition from one to the other is almost never gradual. Put the two facts together. The price is being squeezed into the tip of a wedge. Volatility is sitting at the bottom of its range. Momentum is quietly improving. That is not a prediction of direction, but it is a very loud prediction of magnitude. Something big is being built here, and it is being built in silence. For an investor, that is not a reason to be nervous. That is a reason to be ready. Don't be nervous, be ready. Because the people who get hurt in a volatility expansion are the one who decides what to do after it starts, which is the easiest thing to do. But the people who profit are the one who wrote the plan down while it was still boring. In January 1980, silver peaked around 49.45. In April of 1211, it peaked around 49.80. 2 generations of investor. 2 enormous bull markets, and both of them died at the same address. For 45 years, that $50 line was the roof of the silver market. $50 line was the roof of the silver market. And in January of this year, silver went through it like it was not there. Now, here's the part I want you to hold on to, right? We are 50%, 51 to 52% off the high. That sounds brutal, but a 59.39 is still 19% above the level that capped this metal for 2 generations. The old ceiling has become the new floor. Chart tacticians have a name for that flip, and it is one of the most durable patterns in all of the market. So when you read a headline that says silver has crashed, Hold both thoughts at once. Down 51% from a vertical margin driven spike and permanently above a barrier that stood since Jimmy Carter was president. Both are true. Only one of them tells you where the trend is. So let's recap. I'm at 57. There's not much silver going around. The technical indicator seems to indicate that we are going down, but not that fast in terms of the RSI. And now I'm telling you that historically, $50 is kind of the bare bone bottom line, because don't forget, there's also to make it worth it for silver miners to actually do their jobs. For example, I think that for oil, if oil is below $30, it's not worth to do anything. Maybe now it's probably higher, 30, 40. There's a floor right below this, not worth digging for the stuff. $50. We're getting there. Nothing on a chart happens in a vacuum, right? So let's talk about why silver has been under pressure. Because understanding the why tells you what has to change for it to stop. These things have been leaning on this market. Thing number one, the Federal Reserve. At the June meeting, under the new chair, Kevin Walsh, the Fed held rates at 3.5 to 3/4 unanimous vote. But the projections told a different story. The Fed raised its inflation forecast for this year from 2.7% all the way up to 3.6%. And the committee's own dot plot now implies a possibility of a rate hike before year end. The June minutes show the committee split roughly down the middle. The next decision lands on the 29th of July, next week. So why does this matter for a lump of metal? Because silver pays you nothing, no dividend, no coupon. When safe government bonds pay more, holding silver costs you more in what you gave up. That is the single biggest headwind on this chart. Number two, oil in the Middle East. The conflict involving the United States and Iran has pushed energy prices higher, and Red Sea shipping has been disrupted again. So normally war is good for precious metal, but this time the market has read it differently. Higher oil means high inflation, means the Fed stays tight. And tight policy outweighs the safe haven bid. That is a mechanism that has kept silver capped. Three, industrial demand. With silver averaging so high, manufacturers did what manufacturers always do. They use less. Solar panel, huge silver consumer. They cut their silver consumption by roughly 19% this year. And now flip every one of those around, because it is where it gets interesting. If inflation cools even slightly, the hike disappears and the biggest headwind becomes a tailwind. If the Middle East premium fades, the dollar softens. And here's the one thing that people miss entirely. Solar makers cut 19% of their silver use, and the global deficit still got wider. Demand destruction was not enough. That tells you the shortage is coming from the supply side, and supply cannot be talked into existence if you don't have it. The metal does not care about the price. Charts basically show you what traders believe. This one shows you what is physically happening in the world, and the two have gone in opposite direction all year. Global mine production has been stuck near 830 million ounces a year for a decade. And here's the piece almost nobody understands. Most silver is not mined on purpose. It comes out of the ground as a byproduct of digging for copper, gold, lead, or zinc, which means a higher silver price does not produce more silver. You cannot flip the switch. That is why this deficit has now run 6 consecutive years without correcting itself. And recycling does not save you either. It's been flat near 185 million ounces for 5 years. Because silver in most electronics is measured in fraction of a gram. It costs more to recover than it's worth. Meanwhile, investment demand is going the other way. The Silver Institute expects physical investment, coin and bars, to rise around 18% this year. So follow the logic all the way here, right? Supply is inelastic and flat. Industrial demand fell and the deficit still widened. Retail buyers are stepping back in at these prices. And 762 million ounces of buffer stock has already been consumed. That buffer is what's been absorbing the shortage. Buffers do not last forever. When it thins out, price stops being a negotiation and starts to be an auction. You could see the silver lining, right? I mean, technically, we are too low, right? We're pushing further down, but with less energy. We are approaching the bottom number. There's not enough silver to go around. What do you think is going to happen ultimately? All you need to hear is the Fed saying, you know what, we got inflation under control. And all you need to hear is that war in the Middle East is over. So you get yourself four cases. You have the base case, 45% odds, $58 to $60. Basically, silver builds a base between the floor and the ceiling for another 4 to 8 weeks. The Fed holds on the 29, meaning they don't change the rates. Oil comes and the wedge resolves gently upward towards the 100-day average near 59 and then 61, boring, constructive, and the most likely single outcome. The bull version, 25%, between 70 and 79. Clean week closes above 61, confirms the wedge break. That opens to $70. What I mean by that, not that they're going to lower the rates, but they say it's not that bad, that's strong, which we have seen so far, and this thing in the Middle East is temporary, so 25% chance. The bear market, 20%, is we go in the 46 to 52 area, right? That invalidates the wedge. I don't believe they're going to raise interest rates, or a sharp dollar rally, and this still is above the 45-year ceiling. Then, of course, you have the black swan, the 10%. The buffer stock story goes from spreadsheet to headline, a delivery squeeze, warehouse stress. I don't know, we have a live template for exactly this, January of this year, right? Silver added nearly 70%. So, black swan could be both ways, by the way. So let me be blunt about this one, because this channel is named for it. A black swan is not a crash, it's a violent, low probability repricing that transfer wealth from the unprepared to the prepared. In January, it went up. People who owned silver before the headline made a fortune in 4 weeks. People who bought after the headlines, they bought the top. And notice something about the shape of this map. The bear case costs you roughly 20%. The bull case pays you roughly 30 to 33%. The tail case pays you 60 to 100%. The asymmetry is pointing one direction, and it is not down. Let's take a look at the investor playbook. Because, what do you do with all this? And here's why, if gold simply stays where it is and the ratio compresses back to 65, silver is worth about 60 to 30. If it compresses to 55, a level which charged 2 months ago, then silver is worth about 70, 60. Gold does not have to go, and gold, doesn't have to do anything at all. Silver is still cheap next to gold. And that gap is where the fuel lives. Take a look at the chart. So what does Wall Street thinks about, right? The consensus is around 79.57. Today, that's almost 30% gap between where silver trades and where the professionals say it should average. Either they are wrong or the market is early. One, size is like a tail bet, not a conviction bet. There is a formula called the Kelly criterion, and what it really says is this: bet in proportion of your hedge, never more. 2, use a barbell. This means putting most of your money in something safe or boring and a small slice in something with explosive upside. 3, let the chart do the deciding, not your mood. 4, know which vehicle you are using and why. Physical metal is for the tail scenario, and you accept the dealer spread. Broad silver funds track the price without storage headaches. Miners give you the leverage in both directions, roughly 2 to 3 times the move. Different tools, different jobs. Do not use a miner when you meant to own metal. So, recap. Silver is 50% plus below its record and 19% above the ceiling that held it down for 45 years. The chart is squeezing into a point. Volatility is at the floor of its range. Momentum is quietly improving while price is not. The physical shortage is in its 6th year and got wider. And the professional consensus sits 34% above the last trade. None of that tells you what happens next, but it gives you a pretty good idea of what to do. That is all message. The whole message is not fear, it's preparation. Volatility is not the enemy of the investor. Volatility is a mechanism by which assets move from people who did not have a plan to people who did. Every one of these moments have produced both. The only variable you control is which side of that transfer you're standing on. And the way you control it is by writing your levels down while the market is still quiet. Right now, it is very quiet. Be sharp, be first, and be right.